One of the things about our show is it's going to be unique.
You are what you do. You can say any amount of things that you want to say, but what you do is what everybody sees.
People are like, "Oh, I'm just going to JV it. Like, let's just JV it." Like, what the hell does that mean?
I cannot tell you how excited I am to hang out with you guys today. So thank you so much.
Well, then that end buyer could come back and say, "Well, I didn't fully understand that it was subject to."
That's not a thing. Like, the SEC has thought of all of these things. They've been here since 1932.
And you can do what you want with your property.
Buyers have time, they have negotiating power, they have options.
Oh my gosh, I am blown away by your inexperience, and they've been in business 20 years.
And that includes things other people put on your property, right? It's your property, okay? Suddenly Cousin Jimmy's in a lawsuit.
A novation is replacing one contract or one obligation with another.
Out with the old, in with the new.
Yes.
Hey, everybody. Welcome to the show. Today, we're talking about taxes and taxes for real estate investors. I'm Andy Fowler, and I'm here with Sean St. Clair. If you're new to the show, make sure to give us a like and subscribe to our channels. You can find us on Facebook. You can find us on YouTube, and you can find us on Twitter. On YouTube, we are at InRem Podcast. That is at InRem Podcast. In addition, you can find the audio version of our podcast on Spotify as well as on Apple Podcasts. Make sure to go there. Make sure to leave us a review and download our episode and subscribe. We'd really appreciate it. With that, we're going to go to Sean, who has our legal update.
Thank you, Andy. So my legal update today continues on with the what if questions that I've been doing. So the what if question for today is, what if your end buyer or assignee of an assigned purchase contract fails to perform? So you've put a contract or a property under contract. You're the original buyer and you decide that you're going to wholesale it. You're going to assign it to somebody who's going to be the end buyer. And the end buyer then is struggling to perform, or they're not communicating, or it just doesn't look like, hey, this thing's going to happen with this end buyer. They're not performing. And then you get to the close of escrow date, and all of a sudden that end buyer fails. They don't close. They don't provide the funding. And now you have a contract that's out there, but no end buyer. What does that mean to you as the original buyer and the assigner of the purchase contract? Well, your remedies and what you can do really depend upon the language of the contract itself and then the language of the assignment. Most real estate purchase contracts have a cure period, which means that if the close of escrow date comes and goes, that doesn't mean that the contract is automatically terminated. What that generally means is that the seller must come forward and send out a notice, a written notice to the buyer saying, hey, this close of escrow date came, it went, and you failed to close. You are in breach. And if you don't close within, sometimes it's 3 days, it can be longer. The purchase contract that I prepare for wholesalers has a 10-day cure period. But if you don't close within the 3-day or the 10-day cure period here, then we don't have a contract. It's terminated and I get to keep the earnest money. Well, you as the original buyer want to do something with the contract, right? Because now you're within that cure period. You're thinking, okay, maybe I can close on it. Maybe I can find an end buyer, but maybe let's figure out what the options are. So can the end buyer then say, okay, I'll do something within the cure period? Maybe, maybe not. It depends upon the language then of the assignment. Does the assignment provide an exception to the assignment of rights under the contract for the end buyer's right to receive a cure notice under the contract? What I mean by that is, does the assignment basically tell the end buyer, hey, here's the close of escrow date. If you don't close by this escrow date, the rights under the purchase contract automatically revert to the original buyer, and you have no further rights. You do not have a right to receive a cure notice. See, an assignment generally assigns all rights under a contract to the third party, meaning the full bundle of rights is assigned, which would include the right to receive a cure notice. Most assignments are, a couple of sentences, a one-page document that basically say, I, as the buyer under this contract, assign to you, assignee, all my right, title, and interest in this purchase contract, and you give it all to the assignee / end buyer. And if you do that, the end buyer has a right to basically receive the cure notice and perform, and you have no rights. You're out. You can't do anything. So you need to make sure that the assignment states, I am assigning to you all of my rights except the right to receive a cure notice from the seller, meaning the minute you don't perform by the closing date, you are out, and that the rights under the contract revert back to me as the original buyer. And then at that point, I have the benefit of the cure notice. I can either perform or I can go find another end buyer who can perform, but the original end buyer, the original assignee, has no ability to control that, no ability to be involved. They're out of the picture, and you can move forward to maybe save the transaction. So that's what happens if the end buyer of an assigned purchase contract fails to perform.
All right. Thank you, Sean. With that, let's talk about a few updates and announcements here at the NREM podcast. A reminder, tomorrow, every Wednesday at 5:00 p.m., we have our Creative Finance Collective. So what is the Creative Finance Collective? That's a collection, a membership of professionals in the creative finance space from a variety of different states and jurisdictions that come together every week to discuss creative finance. And we do that for multiple different reasons. One of those reasons is it helps us as lawyers grow and make our understanding and our practice in the area of creative finance better. It helps hone really our skills, but what it also does is provide you, the listener, an outlet to be able to hear what's going on, and most importantly, ask creative finance questions to lawyers from a variety of different places. That comes at a real enormous tangible value to you, the listener. Not anymore do you have to, well, I should restate that. You always need to consult a lawyer in your state regarding your specific state legal issue. But if you have ever wanted to hear how different lawyers approach creative finance from different topics, this is your opportunity to ask any question you can think of we make ourselves available for the entire hour. And we've got lawyers from Ohio, from California, from Arizona, from Texas, from Georgia, from Alabama. We've got lawyers from all over the country who have participated in this and who may participate in any given week. So it's an important opportunity for you to be a part of and to be involved with and ask any questions that you have. So remember to be a part of that every Wednesday, 5:00 p.m. Arizona time. We are live on Facebook, YouTube, and Twitter. All you got to do is log on, watch, ask your questions. And if you got multiple questions, we'll take those as well. So that's important to be a part of. Again, 5:00 every Wednesday, 5 p.m. Arizona time, the Creative Finance Collective. Also, today we're talking about taxes, real estate taxes, tax structure, strategy. That's an important topic, and you may have questions about that topic as well. And as you know, every live show, we take questions in the final 15 minutes of every episode. So I'm going to turn it over to Mayu, who can give you instructions on how to go ahead and post those questions and be a part of our show today.
Good morning, investors. Once again, we are live on the NREM podcast. As always, you do know that Andy, Sean, and our guests are here to answer your questions live on the show. If you're watching in REM, whether it's from our YouTube or Facebook pages, we are monitoring our comments for your questions. We only take about 10 to 15 minutes at the end of the show, so don't wait. If you have a great question in mind, feel free to drop it in the comments, and we'll try to get to all of them at the end of the podcast. So tell us again what today's topic is, Andy, and let's go ahead and get into it.
All right. Thank you, Mayu. Okay. So today's topic is planning makes perfect taxes for real estate investors. So we're talking about taxes that you as real estate investors may face, ways to plan for that, strategies, so on and so forth. And with us to discuss that topic is Larry West with Precision Business Strategies outside of Texas. Larry, thanks so much for joining us.
Hey, thank you for the opportunity.
Yeah, so happy to have you. So Larry, tell us about you, your practice, your business, and how you got involved in doing what you do.
Yeah, absolutely. So I'll give you the Cliff Notes version of my life story that led to this tax nerdship, as I call it. The short of it is, coming out of school, I thought I was going to go into investment banking and get a high profile job in Chicago, New York, or somewhere in that area. But I ended up, my path brought me to Abilene, Texas, which anyone who knows anything about Texas, Abilene is in West Texas. It's kind of in the middle of nowhere. As you're driving, boom, there's this little bitty city. And the short of it is, there were no jobs that I was looking for, no IB jobs that were to be had in that particular city. And so I had to quickly search for plan B. What happened is, at the time, I connected with a financial advisor who had a growing practice. He had an RIA, and he said, "Hey, I could really use someone who understands taxation." My MBA at the time was in finance and accounting, and so I had some understanding, some novice level understanding of taxation, but a professional by no means. But I needed a job, and so I said, "Look, I'll take it." He gave me a job, stuck me in the back office, and said, "Look, when we come up with strategies and plans for our clients' financial strategies, I'm going to look to you to tell me what the tax implications are. So I just need you to figure that part out." And that's where I really cut my teeth learning tax strategy and tax planning. Fast forward a little bit, I went from there to go on to earn my enrolled agent designation, which is a designation directly from the IRS. It authorizes folks with the EA license to represent taxpayers before the IRS. So that's in all cases involving audits and tax resolution and things like that. And so the exam itself is hyper focused on US tax law, both personal tax law, business tax law, and then, of course, as any good exam or credential, there's an ethics component attached. After I left Abilene, I moved over to Dallas, Texas. And once I got to Dallas, I really started working for some traditional CPA firms out there. And by traditional CPA firms, these are essentially firms that do a little bit of accounting and bookkeeping, but primarily their their tax shops. They do tax preparation. That's somewhere around 60, 70% of the business. And so I got thrown into that fray and really handling public accounting and public tax from the perspective of personal tax returns, business tax returns, trust tax returns, and what have you. Um, a couple of years into that, I started to think about the strategy where I started at that financial planning firm in Abilene. Everything revolved around strategy and planning, not so much the preparation piece. And tax prep is important, but the reality is it memorializes the data from the prior year. And so while that needs to be accurate, T's need to be crossed, I's need to be dotted. There, there leaves very little room for proactive strategy and planning when your primary focus is preparation. And so the firm I was working for at the time, I started working with them to help build out the consulting side of their practice. And the consulting side really focused exclusively on how do we have the conversations now about what's going to happen tomorrow, as opposed to having the conversations today about what did happen yesterday. And after that, I came to a point where I decided it was time to strike out on my own and hang my own shield. And so a couple of years ago, we started Precision Business Strategies, and our focus is just that. Our focus is really proactive strategy and planning for the business owner. And essentially, what that comes down to is we want to make sure your financials with the company are pristine and in line. Because if we don't have good data coming in, if the financials from the company coming in aren't up to date, aren't appropriate, aren't valid, aren't accurate, then the strategies that we put together are essentially meaningless. So, good data coming in, we focus a lot on financial analysis, cash flow planning, forecasting to really get a sense for how the business will perform, and also some business strategy to make sure we're able to take the company to new heights. From there, we then roll into tax planning and tax strategy. Because if we've done our job right on the first side, then we've created a tax problem for you. We've created profitability, we've created income, and now we sit down and talk about strategies. What are the best ways for you to tax plan to protect more of your wealth and not necessarily give it all the way to taxation? Everybody should pay their fair share, of course, of taxation, but doesn't necessarily mean you need to pay a dollar more. So, effective strategy and planning, again, is at the core and foundation of everything that we do.
Well, Larry, I love that because I think the planning and the strategy is so oftentimes a forgotten piece in tax planning. It was for me personally for the first half of my adult life. You arrived with your tax preparer, and it was just to gather what had been done the prior year and plug in numbers. And I got to a frustration point where I'm like, well, how can I plan to make these numbers better? Why aren't we meeting ahead of time? And I was working with somebody at the time who just plugged in numbers, and you realize how important it is to start planning well in advance of that, rather than just approach it after everything's locked in at the beginning of a new year when everything the past year doesn't matter anymore. Larry, now you work with real estate investors as well. How did you develop a niche doing that?
Yeah, what I realized early on was that as we started working with more and more wealthy clients, there was an underlying theme with all of them. Either they made their money in real estate or they had it as a part of their strategy from a tax planning perspective. And this went a number of different ways. And then personally, just as an investor, having an interest in real estate, it tends to be one of the few asset classes that allows you to make more money, but not necessarily increase your tax bill along the way because there are so many opportunities available to you as a real estate investor. And so it just naturally became a part of our focus from a planning perspective. And more of our clients are falling into that space. And again, just among the wealthier clients that we've worked with and that we continue to work with, it is a foundational part of what they do going forward.
So, one question that we approach and deal with on our show, this is a show devoted to the law for real estate investors. So, Sean and I are attorneys, and we spend a lot of time talking about the legal reasons why you might structure things one way or not structure things another way. But one of the things that we come into contact a lot with is there are legal reasons to do things, but then there are tax considerations and tax reasons to either do things in addition or maybe to consider doing things um, slightly different. So
Mhm.
oftentimes a listener, somebody who's considering getting into the real estate space, because if they're really thinking about taxes and the law and those kind of things and being proactive and thinking about it, they're going to think about this very early on in the process. That's hopefully the idea, right? So they come to you and they say, Larry, I've been thinking about getting into real estate. This is something I'm excited about. This is what I want to build my business around. Where do I start? So somebody just coming into the space, how would you advise them to best start setting up what they're doing to provide them the best tax benefits?
Yeah, we start with a very important phrase slash question, and it starts like this: How you make your money tells us how that money will be taxed. And so the first part of it is real estate has so many different areas that you can get into. Which part are you interested in focusing on? Is this going to be wholesaling, fixing and flipping, develop and sell, or is this going to be a asset strategy, which is a long term hold? I'm going to buy it, hold it, rent it out, whether that's short term or long term rental or what have you, because those have two totally different implications. And as we talk about structure and we get into the conversations with legal, depending on which side they are on, we'll have recommendations on the type of structure we think would be the most tax efficient. So that's the first part: is what avenue are you going to go into? And from there, once we understand that, then the entity structure, the next part of that is how you make your money determines how it's taxed. How it's taxed tells us the most appropriate structure to mitigate against that tax. And so then we start to have conversations around, does it make sense to look at single member LLC versus multi member? What are the tax implications there? Especially if you're on the side of what the IRS calls a dealer, fix and flip, wholesale, develop and sell. Does it make sense to make a tax election to be taxed as an S corporation for the type of structure? Because all of those decisions, again, that we make on the front end will have long-term implications down the line. And after we've figured those two things out, how they're making their money, what the most appropriate structure is, then we jump into a little bit more of I'm going to call it the accounting and bookkeeping side. How do we track the money appropriately? What does the flow of funds need to look like? Not just to help protect on the accounting side, but also legal reasons, right? We get into conversations around commingling and how you pierce corporate veils that way. And from there, the conversation really starts to evolve more towards the long term goals.
So, Larry, let's start first with the long term holds. And this is one that I personally even struggle with, because I'm not sure I fully appreciate or understand the significance. But I've been told by investors that, okay, if I'm going to have a long-term buy and hold structure, that what they want to, my tax professional has said that they want to see basically a holding company followed by, the actual entities that own the real estate, which would be disregarded entities generally, that, the holding company wholly owns those. But they want the holding company to be a partnership as opposed to a sole proprietorship or a sole owner. And I'm not sure I fully understand why. Can and you're kind of shaking your head like, yeah.
Yeah.
Can you explain that to me and our listeners?
Yeah, I'll try to preface it by saying, sometimes, and we often give disclaimers, but I think a lot of us are guilty of it. We kind of step into the legal world a little bit based on our experiences, and that really drives the recommendation. So here's the thought behind it. When you do the holding company strategy, and you have multiple entities underneath, what the tax professional is typically thinking about is, how do we give you both asset planning and tax planning at the same time? From the tax side of things, what we know is the tax outcome won't change. Whether you do a single member LLC or you insert the holding company, LLC tax as a partnership or what have you, the flow through and how that income actually ends up on the tax return will be the exact same. The goal there is to provide, presumably, I'm going to say, provide some asset planning, in that if your property show up on a corporate tax return, that's inherently separate from your personal tax return. So as you're handing over these documents to whatever third parties, no one's necessarily seeing your entire ownership there. Because when you do this on a 1040 on a personal tax return, Schedule E lays it all out there for you. However, when a partnership is involved, the only thing they see on your personal tax return is a K1 and a number. They then have to go dig into your corporate tax return, your partnership tax return, to figure out on the 8825 what the underlying real estate properties are. So that's usually the thought around it. And the other side to that is, we almost never want to, the reason we don't elect corporations, we almost never want to put real estate under a corporate structure, whether it's the S corp or the C corp, for longer term tax reasons. So that's generally why we see that holding company LLC tax as a partnership.
Yeah. So, and I kind of understand, but so correct me if I'm wrong then. The taxation is the same. It's just a matter of creating a little greater wall of protection from an asset protection
Yep,
standpoint. Is that correct?
that's correct.
S- So one of the things that, when we're asset planning, maybe we create a trust to work around it or things like that. But at the end of the day, it's really easy when I have a married couple come to me and I'm like, okay, we can definitely make a partnership, like that's easy. But, I have a single individual come to me and they're an investor and they're saying, well, I'm not married, but I want this partnership taxation at the top. And, how do I get it? What has been kind of your recommendation in structuring that top holding company so that it ends up with, partnership taxation when you're dealing with a single individual that's going to own or be the sole member? Potentially, well, obviously they won't be to create partnership, but where do you find that extra member, that second member,
Gotcha. So behind the scenes, what we've seen done, where folks pull in that extra member, is another single member LLC that essentially does nothing. Right? Its
Mm.
only job is to serve the role of that other member. And again, stopping short of trying to step too far into the legal side of things. On the tax side, again, the flow through means nothing, or excuse me, it doesn't change. It all comes through the exact same. But that structure essentially gives them the additional layer or presumed layer of protection or anonymity or whatever they may be looking for. The way we handle it is really two ways. One, what is the ultimate long term goal here? And what's the priority for them? What are they after? Because if it is prioritizing the asset protection side of things over all else, we bring in legal and we have the conversations together. Sort of like you and I are doing now. We kind of have these
Mhm.
conversations back and forth to see if it all makes sense. And then we also explain the increased compliance cost that comes along with that, because you've got an extra corporate tax return or excuse me, partnership tax return that you'll need to file. You possibly have some extra state filings that you'll need to keep up with, having another entity layer, and a number of things that may roll out from that. Is the additional increased cost worth the goal? And can the goal actually be realized? And if it makes sense, well, again, as long as everyone is in agreement, we roll with it. And sometimes clients will look at it and say, well, I don't want to pay the extra X number, whatever that may be. I'm okay with this structure as long as we achieve the same tax outcome.
Yeah. Well, speaking of asset protection, and I'm kind of jumping off course just a little bit because this question has come up a lot recently, and with my clients, and it deals with capital gains. And so, two out of the last 5 years, if you've lived there 2 out of the last 5 years is your primary residence, then you can avoid capital gains. And so, the common scenario is, I have my investor clients, they have their primary residence, and of course they're investors, and like, well, I've lived here 2 years, great. I'm going to, move out and turn it into a rental. And, in 2.5 years from now, I'm going to list it for sale and get it sold by the end of that, third year. So I'm good, but they want asset protection.
Mhm.
And so the property is titled in their personal name or their, revocable trust. And then they say, well, but if I put a tenant in there, I don't want to keep this property in my name. I want to move it into an LLC, for asset protection. And my advice to them always is, well, go talk to your CPA and make sure that you can still claim the capital gains. And, 3 years from now, if you do it that way. What is the answer to that? If they have it in their individual name, then they move it into the name of the LLC, and then they go to sell the property to take advantage of the capital gains. Can they still take advantage of that if they've moved it out of their name?
Yeah, great question. And so here's the interesting part. It's the exact same, assuming this is a single member LLC, right? Whether they continue to hold it in their name or push it into the LLC, the outcome there is going to be the same. And here's why. Um, the 121 exclusion that we're talking about, two out of the last 5 years, the part that people forget, and this is the case whether it's in the LLC or out of it, the moment you turn it into a business property or rental property, you have depreciation. And that exclusion is going to be reduced by some calculation according to the depreciation that you took. And whether you took that depreciation holding it in the LLC or holding it personally, the results are going to be the exact same. The only difference here, jump into the legal side, is does it really give you the protection you're looking for? And so that's the only, I'm going to say variable, or that's the main variable, I should say, that we will work through. Otherwise, the result remains the exact same.
And are there any tax consequences from, let's say I bought it 2 years ago, purchased it for, 400,000. It's now worth 600,000. And I'm going to transfer it to my LLC for that asset protection purpose because I'm no longer residing there. I'm going to turn it into a rental. When I convey it to that LLC, are there any tax consequences resulting from that conveyance if the property is now, worth 600,000?
That's a great question. Again, assuming single member LLC, there typically are not any tax consequences there, given that it's disregarded in the eyes of the IRS. You're essentially considered one, even though for legal purposes you are two separate. So there usually are not going to be tax consequences. Now, I'll give you a couple of gotchas that we've seen. Some people will do that, and I don't know under whose guise or advice, they'll go and elect to have that LLC taxed as an S corporation. Now we've got a problem, especially if you try to move it out, because then it has to be distributed at fair market gain, and you end up with tax situations there. But again, going back to the original part, assuming we remain single member LLC, usually not a tax consequence to contribute or distribute it in and out of that entity.
Good. Yeah, that's great information. Thank you for that. And I'm assuming that the entity has to be the same ownership as the real estate. So if, husband and wife owned it, the husband and wife should be the members of that LLC, or a single individual owned it, that individual. You shouldn't bring in partners or investors and add them to the LLC because that might mess everything up, right?
That is correct. You're absolutely right. And that's where the fact pattern has to be appropriate, and everything needs to track and follow correctly. And the moment you do move from single member to multi-member, or perhaps make different elections, you've changed the entire tax structure, and there could be other consequences lying ahead.
So Larry, sticking with kind of the same line of questioning we're talking about here, which I think started with Sean's initial hypothetical of being long-term holds. And
Mhm.
I know this can change, but in a long-term hold, just kind of backing up and more basic, I think you mentioned it's less preferable to have that under a corporate tax structure. Why is that in a long-term hold?
Now we get into the fun nerd stuff. So here's the I'm going to try to put this in the most layman terms possible. When you have a property inside of a corporation, especially when you're a long-term real estate investor, a lot of times you find yourself taking the note in your personal name and then later deeding that property into an LLC, or some other type of structure, right? So now you've transferred ownership from yourself to the structure, and then you go to refi or you go to sell, and the bank says, "Hold on, pump the brakes. Why is this name on title, not yours, who we have the note with?" So you have to deed it out. Transactions like that, when you change ownership under a corporate structure, those are considered distributions at fair market value. So in this example, $400,000 property, let's assume over a couple of years it rises to 600,000, and now you have to deed that property out, or perhaps it transfers at because of a death in the family or something like that. That now potentially becomes a taxable event at the $600,000 mark, not for which you initially purchased it. So you
Mm.
could be hit with a capital gain of 200,000 on a transaction that you essentially made no money on. The other thing is, we know for corporations you have to establish basis, or even for partnerships you establish basis. What you've contributed, less what you've taken out, the net between those basically establishes your basis. When you have rental property, your depreciation deduction that you get each year decreases your basis in that property. And when we're doing advanced strategies like cost segregation studies that give us massive depreciation in a particular year, it could drive our basis, not just in the property, but our basis in the corporate stock below zero. Well, technically, you can't go below zero, but it could just drive it down to zero, which effectively means any transaction that happens beyond that could potentially be taxable. If you try to take a distribution from your S corporation and you have no basis in the S corp stock, that's now taxable as a dividend. Where in other cases, it could be considered just a regular distribution or return of your capital. So, because real estate gives you all these tax advantages, it almost makes no sense to push it into the corporate structure. And the last thing I'll say too is, a lot of times when we elect to be taxed as an S corporation, quite frankly, we're trying to escape Social Security and Medicare tax, employment tax, as most people call it. Remember my first phrase: how you make your money determines how that money is taxed. When you make your money through passive income as defined by the IRS, not us as investors, that's generally rental income, interest income, or other type of investment related income. That's considered passive in the eyes of the IRS, which is essentially means it's not subject to Social Security or Medicare tax. So there's no reason to use an S corporation because the money that you're earning is already tax advantaged from that perspective. So those are three reasons. There are also some very important estate planning and wealth planning reasons that we don't want to do it, but I think those are three of the more basic reasons.
Okay, that's very interesting and frightening all at the same time. So let me boil this down to it. Of course, this would never happen because nobody ever comes to your office or our office like this, but says, all I want to do is invest in buy and holds. That's what I'm going to do. The currency is only going to continue to debase over time. I want to make my money in real estate. I'm just going to buy and hold. What is the ideal in that situation, structured? No entity at all?
Well, we definitely would recommend at the very least an LLC. And the reason we like the LLC, again, on the tax side of things, we continue to maintain the same integrity of the tax advantage that comes through from rental real estate. But now we're able to achieve some level of asset protection by separating the individual from the operations of the business, presumably. So that's where we basically start. And then, depending on if they're investing in one state or multiple states, we may have other conversations about adding additional entities in those particular states and maybe come back to that holding company strategy we talked about at the very beginning. But almost certainly, it would be a number of either just single member LLCs or perhaps multi member LLCs if they have partners going in. I can't see just under that particular scenario. And obviously, there are a number of underlying things we'd have to consider, but I can't see anywhere where an S corporation election or even a C corporation election would fit into that umbrella.
Yeah, one of the things that, or one of the reasons why I like having the holding company, especially here in Arizona, is we are able to create an operating agreement for that holding company that says, who can sign and all of this stuff, the authorized representatives and the whole thing, do maybe one resolution for that company. And then we can go and just form disregarded entities, wholly owned entities under that holding company. And at least here in Arizona, we don't have to do operating agreements each time we form a new LLC because it's all going to be controlled by that holding company. So it's really, quick and cheap. And in Arizona, if I have a holding company and I have a client come to me and say, hey, I'm about to buy this property. We're closing tomorrow. Here's the address. I want a new LLC fully owned by my holding company. We can literally form it and have it ready to go up and running over to the title company in a matter of hours here in Arizona.
Nice.
Yeah. So that's why I like the holding company. Now, where things get interesting, and the discussions, with my clients get interesting is, hey, do I need a new LLC for every property that I own? And, and as we've done this show and talked to other folks who do business and asset and tax planning, what I've come to realize is the greater the asset protection that you want, the more difficult it will be to maintain the structure, right? I mean, you're talking EINs and tax returns and bank accounts and whatever. So, if you want the greatest asset protection, be prepared to work for it.
Yep.
And most people have problems with just one.
Right. Yes. So, what have you seen as far as your clients and kind of, maybe figuring out like a happy medium of, full on asset protection and logistical nightmares versus pretty good asset protection and manageable as far as the, logistics go?
We try to break it down by kind of cost benefit analysis. And we run it through in exactly how you mentioned it. Of if we go full on asset protection and we say one entity for every single property there, well, here's what happens. So here in Texas, every entity, if you don't do a series LLC, but every entity outside of that, it's $308 to form it. And then you have an annual filing that you need to comply with every year. And if you miss that deadline, it's a $50 penalty. So now, client, do you want the headache of keeping track of 35 entities, 35 filings every year? And by the way, every time we form one, it's $300 plus whatever the legal fees involved there are. Or can we look at potentially consolidating that? And this comes down to your risk tolerance. How much equity are you okay exposing per LLC? Is that $250,000? Is that $500,000? And as we reach those caps and properties, then it may make sense to roll over to the next one. And by the way, don't forget, you also have, and hopefully you have insurance. And so this is really in place that assuming that the insurance caps don't resolve whatever the issue is, how much equity are we okay exposing? Okay, perfect. We hit that number. Now go to the new LLC and we rinse and repeat all over again. There are some that are just hyper focused and I will pay the $300 every single time and I'll deal with the compliance because that's their tolerance. And there are some that are like, okay, I get it, Larry. I don't want all that administrative headache. Let's talk about how we group these together and we pull in the different professionals that we need to make that happen.
Yeah, no, I really like that approach. And it really does come down to risk tolerance. So my clients who try to eliminate some of the logistical hurdles, but they want some asset protection. Normally we talk about, okay, let's start with 5, right? So buy 5 properties, form 5 LLCs. And then when you've done that, let's take a look at the equity, and maybe we can, like you said, rinse and repeat and go through and start adding to those until you get to the point where you're just not comfortable from an equity perspective within a particular LLC. And then you just move on and keep filling those LLCs up until you get comfortable there. And then, you could do that pattern, again, and keep doing it to build your empire, if you will. One of the things that our clients come to us about, and I'm not a huge fan of it, but I'm always interested in other professionals' takes. They come and they say, all right, I'm going to invest and I need a land trust, or I need some trust that they think is going to give them this amazing tax benefit and asset protection. And I always tell them there's no such thing. But maybe I'm completely off base, and you're like, Sean, what have you been telling your clients this long? But talk to us about trusts. Is there really any benefit for creating some form of land trust structure from a tax perspective that's going to, do this amazing thing for them from, as far as their taxes go?
Yes. And the reason I laugh is because we get that quite often as well. And there are no shortage of TikTok and Instagram reel videos that talk about just throw everything in a business trust and distribute it to a family trust, and you'll never pay taxes. 99% of the people don't know this is what the wealthy do. It's like, whoa, pump the brakes, because that's not true. Okay. Some of that may be tax evasion, but that's a later topic. So here's the deal with trust. What the conversation we have really starts here. The point of the trust at the foundational side is long-term strategy and planning as it relates to your estate. As we know, when we look at living revocable trusts, those are simply pass-through entities. And correct me if I shouldn't call them entities, but correct me if I'm wrong. They essentially allow your assets to pass on to your beneficiaries while not going through probate, because who wants a judge that you've never met in your life to decide where your assets that you spent a lifetime building to go? From there, we start to then discover what level of wealth are we currently at, and what are the long-term implications if and when something happens? Do we need to get into the giving conversation? Do we need to start to have conversations about irrevocable trusts that have specific provisions? But it's a level that we essentially step through. When it almost all the time they say, well, what about a land trust? And my response is usually the same. The land trust usually doesn't provide any additional income tax benefits. So it doesn't allow you to save on income tax or mitigate income tax. And remember, real estate is fairly tax efficient anyway. Now, I don't know what it means at a hyper local level, because some people may have property tax implications and different things like that, depending on their state. So that may be different. But in the grand scheme of things, it doesn't do anything for your income tax side of things. So whether you use it or don't use it, I think comes down to, does it matter for your asset planning side versus your tax side?
Yeah. And don't get me wrong. I mean, there are attorneys, and they're high-end attorneys, and they charge a lot of money, and they're worth it, who can use trust strategies to lower your overall assets so that you're not hit with estate taxation.
Absolutely.
We're talking about, right now, I think that the estate tax exemption is 10 million and change. And so if your assets are over that, anything that's over that is going to be heavily taxed. Mm-hmm. And so there are people who are willing to spend, significant sums today to avoid taxes tomorrow. And I'm all for that. And I have clients who I refer to, some of the bigger firms in Phoenix who have extraordinary tax attorneys and estate planning attorneys who can do it, and they're not cheap. And it's something that you should do. I mean, I think that's proper, is to try to figure out how you're going to best provide for, your heirs and your estate going forward. But I'm talking about like today taxation, income taxation and things like that. And I think that's what you're talking about as well, is, yeah, there are there is long-term tax planning that can be done, but it's not for today's taxes. It's for some later date, frankly, when you're not even alive.
Yep.
Would you agree, with that?
Yep. Absolutely agree.
Larry, so jumping back, we talked about the hypothetical of long buy and holds planning, but a lot of times folks that come in for planning, maybe they want to get into real estate, but they have no idea what their niche is going to be. They're just toying around with everything. I have no evidence behind this other than just mere suspicion, but I have my suspicion is a lot of times real estate investors end up in the buy and hold camp as they mature. There's more of a temptation early on to be in the other camp, which is, I can fix and flip this. And maybe I learned a trade and construction and I can do this. And this is maybe a faster realization of money. So a lot of them either don't know what area they're going to get into, or they're going to explore some of the other side of the real estate coin, which might have a different tax consequence associated with that. For somebody who's really wants to get their feet wet and they're working through, do your recommendations really change on how they need to structure, or are they going to still stay with kind of the basic LLC if it's just you by yourself that's pretty fungible in how you're going to be able to use that?
Well, it may change. Well, let me say this. Usually, we're still going to start with an LLC just as the initial entity. What may or may not change is what tax election we may or may not make. So, if they do take a ride on the wild side and they say, "Hey, I'm going to do some fix and flip projects. I'm going to do some wholesaling," and really go after the cash, or again what the IRS calls dealers, then as they become profitable, we reevaluate either each quarter or each year, depending on how often we're meeting, to see when it makes sense to make the tax election to be taxed as an S corporation, or if it makes sense at all. Because we don't make that decision right away until we've understood how successful the venture is going to be and how profitable they are. Because again, all that comes with extra compliance. You got accounting, payroll, as well as a new tax return that needs to be filed each year. Do the savings justify the additional cost that we're taking on? If they do remain on the buy and hold side, then we may or may not ever make a tax election the other way, that being an LLC tax as a partnership on that side of things. Again, depending on how their empire grows and whether or not it makes sense from a legal and compliance perspective.
Talk to us. This is somewhat unrelated, but a topic in real estate taxation that we're always interested in. We don't really do much of this, but are always interested in how this plays out. Talk to us about 1031 exchanges and when those make sense, and which might depend on kind of given market conditions. But when should a real estate investor be looking from a tax perspective at a 1031 exchange?
Yeah, great question there. So common monikers in the tax space is exchange, 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 and die. And what they're basically saying is look, when you do a 1031 exchange, and it's called a like kind exchange. The IRS essentially says if you exchange real property for real property and follow these other subset of rules, will allow you to defer capital gains tax. And what it basically means is if I hold a property and then I sell it for, I don't know, let's call it $500,000. And whatever the capital gains tax on that $500,000 sale, it is what it is. I have a choice to either bite the bullet and pay the tax or try to go under the 1031. If I follow those rules to a T, which is essentially identifying my new property or properties within 45 days, closing on my new property or properties within 180 days, and the total acquisition of my new property or properties is equal to or greater than my sales price of the old property, then I can defer the capital gain. So I can take that $500,000 that I just got from the sale, take it and put all of it towards new property, or again, multiple properties, as long as the aggregate is above the number, and essentially rinse and repeat my process all over again. Now, instead of one property that was probably a quarter million, I've got several properties with $500,000 of down payment. We could probably buy a million, million five more worth of property. So I've kind of increased my net worth. I've increased my cash flow. And by the way, I did not pay taxes on the sale of that income because I followed the 1031 like kind exchange. It makes sense in the oh, sorry, let me get to the last part of that. The exchange, die. So a lot of people rinse and repeat that process to build their real estate empire until they've kind of reached the end of life, quite frankly. And then they work on transitioning it to the next generation, which can be done very tax efficiently, whether that's a step up in basis or that's some gift planning that may happen before you punch the ticket. I'll say it that way. Uh, so that's the value of the 1031. When does it make sense? When your strategy is, again, long-term holds, the new investment pencils. That means you do your underwriting as an investor first. And as long as the new investment works out to your standards, to your buy box, then it's usually a great idea. But what we've seen is a lot of people are compromising, not wanting to pay the tax on their gain and ending up in really crappy new investments that aren't performing to standard. And so we always say, don't let the tax tail wag the dog. If it makes investment sense, perfect, let's do it. If the deal doesn't pencil, let's find some other strategies because I'd rather have you bite the bullet and pay the tax, worst case scenario, and still have free cash flow to do what you want, as opposed to end up in a dog of an investment, kind of kicking yourself, wishing you had done something different.
So the catch is when the investment strategy ends up costing you more than the tax would have cost.
Yep.
Yeah.
Yep.
So a while back, Congress passed the Inflation Reduction Act, and the president signed that into law, and there was a lot of concern back then about an influx in audits. We heard about the 87,000 new IRS agents, so on and so forth. What has your practice seen? Have you seen any appreciable increase in audits? What does that look like since that passage for you?
No, so we haven't seen an increase in audits. What we have seen an increase in our um, penalty letters. We're also getting penalty abatements processed a little bit faster. It's kind of the low hanging fruit stuff, late filings, late payments, and those kind of things. They're just coming out a lot quicker than they used to be. And not saying that more of them are happening; they're just happening faster than what we've seen over the last couple of years. From the audit side, I don't think we're going to see the fruits of that for a couple of more years. And here's why. Typically, with an audit, very rarely is it, hey, I'm auditing you for something you did last year. It's usually a couple of years down the line, and they're coming back looking at something that was submitted that doesn't quite pass the test from a few years ago. So I think it'll be a couple of years before we actually see that. And then the other side of it, and this is, I'm going to say, subjective, right? There's no validation. This is just my opinion here. When you look at what's going to be audited, I think middle income taxpayers are going to probably feel this more than presumably higher income, wealthier taxpayers for a few reasons. Usually on that end of the spectrum, you've got a tax strategy, tax planning team, attorneys, CPAs, and what have you. And so those strategies are usually buttoned up very tight. The documentation usually is pristine, or you got the pockets to go to court and fight if you want to. It's the middle side of things, and perhaps even on the lower income side, where the record keeping is fairly poor. And when the IRS sends inquiries about, hey, send me documentation for this, it's not there. I think that's where we're going to see a lot of the results of the audits come from. Not what's been floated around in the news, but that's my side of things.
Interesting. So we have a question today. Maya, what is our question from the audience?
Yeah, so we just have one question today. So again, thank you for dropping your questions in the comments. And so the question is as posed: if you're doing buy and holds, flipping and buying and selling and remodeling, how would you structure the business?
Ooh, I like that question. I like that question. So this is where we get into perhaps a multi-layered entity structure where the entity that's doing the fix and flipping would be a separate entity that we'd want the buy and hold to be held in. Okay. And that's for a few reasons. One, the fix and flip income is going to be subject to your federal tax, Social Security, and Medicare tax, all of that stuff. That may be more suited for an S corporation election down the line, whereas your buy and hold is likely going to remain a single member LLC or something of the like. So we'd want to separate those two at the very least. And depending on how much you're doing on both sides, we may look at the holding company structure, but what we would not want to do is one holding company that owns your fix and flip and owns your real estate, because again, then we end up under that umbrella that may not be very tax efficient. But certainly at least two separate entities there.
Very good. Well, Larry, thanks so much for joining us. We really appreciate it. The information's been great. Tell our listeners how they can find and connect with you.
Absolutely. So there are two ways. The easiest way, our website is pb-strategy. So like peanut butter, pb-strategies.com. There's a big blue button at the top right that says become a client. That's where you'll schedule a discovery call and sit with one of our accounting or tax advisors and see if it makes sense for us to work together. The other thing we have is a growing Facebook group. It's called the Strategy Room. So if you search the Strategy Room on Facebook, it's a free group to join. We do 3, sometimes 4 Zooms every month, and we talk about things like this. What are the tax strategies that everyone should be aware of, as well as the business strategies as it relates to growing the business and financial analysis for the company.
Thank you so much, Larry West with Precision Business Strategies. Appreciate it, and hope we can do it again soon.
Absolutely. Thank you all. Really enjoyed this.
Yeah.
Thank you, Larry.
All right. We'll see you. We'll see you next time, Larry. Thanks so much. And for you, the listener, thanks for joining us. We will see you tomorrow for the collective at 5 p.m. and next week. Have a good day.
Have a good day, everyone.
See ya.